Starting your investment journey doesn't have to be complicated or intimidating. Today, we're diving deep into exactly how you can invest $1,000 in the stock market, right now, starting from wherever you are. Whether you've never owned a single share or you're looking to expand your portfolio, this guide will walk you through every single step. And if you're new to building wealth through investing, please hit that subscribe button. We're building a community of people who want to take control of their financial futures, and you're going to fit right in. Let's begin with the fundamental question. Why should you invest $1,000 at all? The answer lies in one of the most powerful concepts in finance: compound interest. When you invest money in the stock market, your investment grows. But here's the magic part. That growth itself starts earning returns. Your money makes money, and then that new money makes even more money. Over decades, this compounds into wealth that far exceeds what you initially put in. A $1,000 investment today could become $10,000, $50,000, or even more by the time you retire, depending on your time horizon and the returns you earn. But before you open an account and start buying stocks, you need to understand what you're actually buying. When you buy a share of stock, you're buying a tiny piece of ownership in a company. Companies need capital to grow, so they sell shares to investors like you. When the company does well, your shares become more valuable. Some companies also pay dividends, which means they share their profits directly with shareholders. This is how you can make money from stocks, through capital appreciation and dividends. Now, here's where most beginners get stuck. They think they need to pick individual stocks, and they get paralyzed by the choice. Should they invest in technology, healthcare, energy? The truth is, unless you have the time and inclination to research individual companies, you're probably better off investing in index funds or exchange-traded funds. These are collections of many stocks bundled together. When you buy an index fund, you're essentially buying a tiny piece of hundreds or thousands of companies at once. This diversification means that if one company struggles, it doesn't tank your entire investment. The most popular index funds track major market indexes. The S&P 500, for example, tracks the 500 largest companies in America. The Total Stock Market Index tracks nearly every publicly traded company in the United States. The advantage is clear: instant diversification, low costs, and historically solid returns. Over the past century, the stock market has returned about 10% per year on average. That's before inflation, but it's still impressive. Step 1 is to choose a brokerage. A brokerage is a company that lets you buy and sell stocks. Some of the most popular brokerages today are Fidelity, Charles Schwab, Vanguard, and Robinhood. Each has different strengths. Some focus on low costs, others on customer service, and others on user-friendly apps. Most offer commission-free trading now, which means you won't pay a fee every time you buy or sell. Many also offer fractional shares, which means you don't need $1,000 just to buy one share of an expensive stock. You can invest any amount you want. Choosing the right brokerage depends on your needs. If you want a sleek mobile app and minimal fees, you might prefer Robinhood. If you want extensive research tools and strong customer support, you might choose Charles Schwab or Fidelity. Vanguard is known for its low-cost index funds and emphasis on long-term investing. Spend an hour comparing. Read reviews. Open an account with the one that feels right to you. This is your financial home base, so choose wisely. Once you've opened an account, you need to fund it. This means linking your bank account and transferring money from your checking or savings account to your brokerage account. The process is straightforward and secure. Most brokerages walk you through it step by step. It typically takes 1 to 3 business days for the money to appear in your brokerage account, though some offer instant transfers. During this time, you can start researching what you want to buy. Now comes the investment decision itself. You have $1,000. What should you do with it? Here's a simple, proven approach that works for most beginners. Invest roughly 70% of your money in a total stock market index fund. This gives you broad exposure to the entire American economy. Take another 20% and invest it in an international stock index fund. This diversifies your risk globally. Finally, put the remaining 10% in a bond index fund. Bonds are loans to companies or governments, and they're less volatile than stocks. They provide stability. This 70-20-10 split is flexible. You can adjust it based on your age and risk tolerance. The younger you are, the more comfortable you can be with stocks, because you have more time to ride out market downturns. If you're nearing retirement, you might want more bonds. The point is to have a strategy before you buy anything. Don't invest based on emotion or hype. Let's walk through exactly what buying looks like. You've chosen Fidelity as your brokerage. You've linked your bank account and you have $1,000 sitting there. You want to invest in a total stock market index fund. You search for a fund with a ticker symbol like VTI or VTSAX. You enter the amount you want to invest. You click buy. And that's it. Congratulations, you now own a piece of the American economy. Some investors make a different choice. Instead of investing all $1,000 at once, they dollar cost average. This means investing smaller amounts regularly over time. You might invest $100 every week for 10 weeks, or $200 every month for 5 months. The advantage is psychological. You feel less pressure about timing the market perfectly, and you reduce the risk of investing all your money right before a market crash. The disadvantage is that over long periods, lump sum investing tends to outperform dollar cost averaging since the market trends upward. But if investing $1,000 all at once makes you anxious, dollar cost averaging is a perfectly valid approach. Here's what most people don't talk about. The hardest part of investing isn't picking the right fund or timing your entry. It's staying the course. Markets go up and down, sometimes violently. You'll have days when your $1,000 investment is worth $900. You'll have days when it's worth $1,100. This volatility is normal. This is the market working. And here's the secret that separates successful investors from everyone else. They don't panic sell during downturns. They know that downturns are temporary, and that historically, the market always recovers. In fact, downturns are opportunities to buy more at lower prices. This is where your time horizon matters enormously. If you need that $1,000 in the next year or two, the stock market isn't the right place for it. Stock market investments should be money you can afford to leave untouched for at least 5 years, ideally 10 or more. The longer your time horizon, the more comfortable you should be with stock market volatility. If you're investing for retirement 3 decades away, stock market crashes should barely register as blips. Taxes are another consideration many new investors overlook. If you're investing with regular money from your checking account, you'll owe capital gains taxes when you sell at a profit. Long-term capital gains, which apply to investments you've held for more than a year, are taxed at favorable rates. Short-term capital gains, which apply to investments sold within a year, are taxed as regular income. This is another reason to buy and hold rather than trade frequently. But here's the better news. If you have earned income, you can invest in a tax-advantaged retirement account instead of a regular brokerage account. In the United States, this means a 401k if your employer offers one, or an IRA if you're self-employed or your employer doesn't offer a retirement plan. These accounts shield your investments from taxes until you withdraw the money in retirement. The money in these accounts grows tax-free. This is one of the most powerful wealth-building tools available to you. Seriously, if your employer offers a 401k with matching, that's free money. Take advantage of it. Let's say you've made your investment. Now what? The answer is beautifully simple. Nothing. You do nothing. You don't check the price every hour or every day. You don't panic when you see headlines about market corrections. You don't try to time the next move. You simply hold. If you've set up automatic contributions, you continue making them. You're building a habit of saving and investing, which compounds over decades. There are a few maintenance tasks worth doing annually. Once a year, review your portfolio. Check whether your 70-20-10 split is still accurate, or whether stock market movements have skewed it. If stocks have grown a lot and now make up 80% of your portfolio, you might rebalance by selling some stocks and buying bonds. This keeps you disciplined and forces you to buy low and sell high, which is the opposite of what emotions want you to do. You should also review your fees once a year. If you're paying 1% per year in fees and the market returns 10%, you're only keeping 9%. Over decades, that 1% difference becomes substantial. Index funds typically charge between 0.03 and 0.2% annually. Avoid actively managed funds that charge 1% or more, unless you have a very good reason. Let's talk about common mistakes that derail new investors. The first is trading too much. Every time you buy and sell, you're paying fees and potentially triggering taxes. You're also proving to yourself that you can't stick to a plan. The people who make the most money from stocks are those who buy and hold for decades. Warren Buffett, the world's most successful investor, holds his positions for years. You should too. The second mistake is chasing performance. You see a technology fund that returned 40% last year, and you want to dump your boring index funds and buy technology. This is exactly backward. Performance chasing causes people to buy high and sell low.